The following is a presentation of TFNN. The Global Market Pulse. With your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. It's Thursday night here in Asia. And it was, again, a nice sunny and rainy day here in the Philippines. Seems like it always kind of goes together. Not a lot happening today except for we've got the CPI coming out at 8:30, the Consumer Price Index. Then we also got, if anybody looks at this, the Bloomberg Consumer Confidence Index at 9:45. And existing home sales probably is the other benchmark usual suspect of announcements coming out at 10 o'clock. So that's some of the things that we just kind of need to be aware of as far as things that might rock the bond market or the kind of knee-jerk the stock market around. Again, I think a lot of things are just kind of settling out here, and I don't know if these things are going to drive the market one way or the other. I've got the dollar up right now in the den, and we've been talking about a higher dollar since we started having some technical damage back. Good gracious. I think back around 81.5 on our weeklies, we started getting some real serious confirmations. But the dailies had obviously triggered a little bit earlier off the profiles. And, we did have a higher high on price action and a lower high. This is our daily chart on the dollar, a lower high on Navigator. Haven't had any overextension bars or anything, but, that type of action, you have to look at these latest moves with a little bit of suspect eyes when these happen like this. Okay, I'll take a look at that. But when we start kind of settling out and churning, this is not the type of action you want to see, as if this were a false high. And there's a rescue spot. I don't know if you can hear it outside. This is a false high, and you need to kind of just get on the short bandwagon. Well, this type of action, based on this divergence, coupled in and the building cause kind of thing here. This is kind of a compression against the unfair highs, and to me this seems technically ripe to move higher. This is not the type of action you want to see if you're short. So I'm kind of ignoring this down here, and I'm ignoring that we had a suspect high here because of this action right now, because there's a number of things that could be happening with the dollar right now, but the world seems to want to devalue their currencies, and the dollar index is a component of that. And fundamentally, I think that just is, not a bad thing to do, is to be long the dollar. So where do you put your stops on a trade like that? I think you got to totally say uncle below 87. I never said that a while ago. I'll say it now. Gold has really been, lately, I know there's kind of been some demand news out there, and demand has changed, and I think that's kind of more almost a blip on the screen relative to what's really going on here with the inflation, no inflation, if you will, and the dollar climbing. But, gold with this last little kind of pogo stand it did above the 1180 area, closed above, kind of retested a couple of times with a little bit of noise factored in fact, today already. I love the way this is acting from the long side. I really, really like this trade now, and I like putting stops below 1180 based on your appetite for risk on the long side, because as this dollar continues to climb, and the dollar, again, may shoot up again while we just looked at that and kind of made some broad statements about it, gold's kind of hanging in there. This is kind of looking launching pad-ish, if you will. So if the dollar does pull back, I think gold would have some pretty serious reasons to move up, on top of just looking relatively ripe to go up anyway. So, if we're not right on that one, we're not right, but it seems like a decent trade to me. All right, I'm looking in the den. Okay. I guess you guys are talking to Basil about that. Okay. All right. Couple of things just to quickly go over, and then we're going to kind of go into a stock world today a little bit later. We're going to chat with Eric for just a little bit about some of the things he's looking at up in on Wall Street today. I didn't really give silver its due lately. It was a great move up from that 1527 area, but we're just having some difficulties here around the 1641 area, rounded off, and I'm still sticking by this. I think the trend still is down on silver, and it'll have some in tandem type moves with gold for sure. But this may be able to be looked at in a kind of equal monetary weighted, each side of the equal sign trade at this point. And tomorrow I'm going to actually show you some, not that it's a classical spread, but just to take a look at how this thing is really acted in a spread format in the e-signal charts. So let's take a look really quick at the S&Ps just to kind of give you an idea of what I'm seeing here on these things. We're down 8.5 points today already from the so-called close yesterday, even though this thing stays open 24 hours a day basically at this stage. And I'm going to pull up our scanner really, really quick here and just show you the breadth situation and show you why I'm still somewhat of a buyer of dips on this thing. So as I look at this, I'm looking at some of the raw data. You'll see it on speedometers if you've got that feature. We do have the 60s changing here. The 240s, and the market's not open yet this morning, so these are going to change a little bit. But again, not to beat a dead horse, but until these longer terms start showing crossovers, and when I say crossovers, you'll see that on the speedometer. But I want to blow this last section up. I'm going to take out the middle section. These are what I call crossovers, and these are when breadth goes from positive to negative, negative to positive, positive to negative, stays negative to that October 17th, 20 area, and it stayed positive. We're pretty, still relatively positive here in a spread ratio. So this is our daily, and this is our weekly situation. Still, and there's that September 19th, and there's the 17th. That the dailies triggered a little bit earlier than the weeklies on the turnaround. But I'm trusting this information. And that being said, as we look at the S&Ps and I look at what's going on here, we've come back down into these unfair highs, 2039 rounded off. But that's only down from 2054. So we're down about, I can't do math anymore. What is that, 15 points from all-time highs? This 2014-2019 area down here is probably going to be more of your maximum support area for the S&Ps. But right now you've got a trading opportunity, even though we're on all-time highs, and that breadth is looking very positive on intermediate to long term. The 60 minutes and 240s, you could have a short-term trade down to this 214-219 area. But again, I'm personally playing this from a little bit longer term view, and I'm okay if we have pullbacks to that area from the long side as long as the breadth on the long term doesn't change. Okay. A lot of guys looking at the NASDAQ, and again, we're going to get into some specific stocks in a little while based off the scanner. Goldman Sachs, ExxonMobil, AT&T, Bank of America, Wells Fargo, my two favorite banks of all times, as you know. Not, and a couple of things that are showing on the other inflection point filters. NASDAQ, you've got a little bit lower inflection point here where relative to where price action is. That's 41.76 on the NASDAQ 100 futures. So we're trading, what is that, 35 points higher right now. So, the NASDAQ has kind of broken stride a little bit earlier on the 240. That's going to be your kind of dig-in area as long as, and we're showing breadth here on the NASDAQ also. As you can see, 62 to 11 there, 43 to 9, 240 still, breadth still positive. The 60s have actually changed, but, again, the long term is kind of what the intermediate to long-term trend is kind of defined by that, in my opinion. So we're going to Turn the rinse the same way on that one. All right. Real quick, just some of the usual suspects we always kind of go through here before we get into some other things. The notes, again, I'm still a big fan of this trade. And any breakouts and closes above this 126.25 area, I'm just going to be tickled pink. We caught a really good move off the unfair lows the other day for a full handle. And this is a relatively thin profile. So, we're going to have some breakouts one way or the other. And we just haven't had that yet on a closing basis. So I'm just kind of patiently waiting here. And I think the other day we were kind of looking at it. I forgot what instrument it was. We were talking about, either accumulation. This is the type of thing I like accumulation on. When we have a relatively thin profile, you can put your stops relatively tight below it. And then, if you get the move up, that's the kind of thing that really can make your whole year. But remember, put your stops in. Haven't looked at these in a while, but I just want to kind of look at January soybeans, because I kind of picked this up off the scanner last night. Here we are, January soybeans right around $10 a bushel. January soybeans, $10.04 a bushel to be exact. And we've kind of, waited till we come down to that support, and then we found it, relatively high probability trade, and then stops oriented below there. I was talking to some of my guys down in the grain elevators last night also, because obviously my night is your day. They're pretty bullish on soybeans right now, and they think some news events are going to kind of impact this. That's just their gut feelings. That doesn't mean anything in technical analysis. But that being said, I'm a big fan of looking at these dual inflection points, previous unfair lows at around 10.01 and current at around 10.04. And the cool thing is to put stops below there. It's really like no harm done. And I think we could climb higher with beans in general. So something we haven't really had on the board in a while, but I just wanted to mention it. Okay, I was going to show one more global index here before we hit the skids. The Nikkei, of course. Talked about this disconnect between the Nikkei and the yen. Here's where we're at, 17,225. Let me just make sure that's the current. 17,225. And we're having a little problem getting through this last profile, which the yen is not. So I think you've got some support down here at 16,807, and that's kind of where I would be patiently waiting to kind of keep that in the long-term uptrend. And I'm going to pull up the yen really quick, because this thing is just insane, out of control. We talked about trading this long yen against the short Nikkei now since the recession talks have come out, and that has really been a nice trade if you've been watching it the past couple of days. This disconnect, and we talked about people having to get out of that spread. We'll be right back, folks.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show. And I'm showing Alibaba on our screen right now. Obviously, there's a little bit of tension in the air with that stock. We talked about waiting patiently until we had a pullback on this. We've got it back to 108.79. And as you can see, we had this profile appear, had the orange bar, had the profile appear, had some good leverage points on this. And we've explored the entire fair auction. We do not have to bounce, but we're sitting. Let me just see where the current pre-market price is on this. Yeah, about where it's at right now. Yeah, can't argue with what this stock has done, and until told differently, until technical damage happens, I think you got to be looking at this as a support area, and then a possible, stop out or reverse below. I'm hearing that we have Eric with us again today. Eric, are you here?
I am here, yes, sir. How are you?
How are you today, the mayor of Wall Street?
Mayor of all of Wall Street, the interference on the radar is because everybody plays that fruit game in the morning in Wall Street. New York, well, I don't know what that crazy fruit game they play on the mobile. I mean, have you seen that?
I haven't heard of that. What is that? No, what is it?
Oh, everybody. It's lemons, oranges, apples, and stuff. They're all sitting, all the idiots on the train playing with this fruit game, or wherever you see them. I've seen people playing it that I am shocked that are playing it. These are guys who are bright guys. I don't know what the hell they're doing. But you know what? Today I'm thinking very seriously about that time of year. And I'm not talking holidays. I'm talking the budget time of year. This is when the budgets are all, everybody's going crazy about their budgets, Your shows have been great. Yesterday, that yen conversation was terrific, and the way you tied in the fundamental basics, but then the real point of decision is the technicals, was perfect. And today, I see that all the other Asian rivals are looking a little bit weak in terms of their currency. So that's been a home. I mean, that's a trade that you've made enough money for people on that trade. You should retire, John. But
well. If I could talk to you every day, I don't want to retire.
No, I'll never. I can't. I don't want to retire. I can't retire. I got in a fight with a guy yesterday who was a derivative trader, and he hit me with his slide ruler right in the nose. Anyway, back to budgets. It looks to me like we're looking at a 17 multiple on the market right now. The chart is just phenomenal. It's almost textbook, the S&P and the Dow. The 17 PE is probably not crazy, but everybody's talking. Now, the new word is mediocre, no more normal. It's now mediocre, whatever mediocre means. God bless them. But I think the key is going to be in budgets. Going back, we were talking before about some of the old-time great physicists who came out of the A-bomb work that they did, bombing the world.
I remember, yeah. What was his name, Oppenheimer?
Oppenheimer, and of course, and there were so many others that were involved, and they found out after they did their work with the bombs that the best place to make money was Wall Street. That's when Wall Street started, the whole game. Louis Batchelor, which was a random walk, then Fisher and Black. What a combination. They were like Laurel and Hardy, really. One guy was crazy, the other guy was very, very conservative. And they were the ones who went through a tremendous amount of, the tail on your bell-shaped curve in terms of overview of what's going on with regard to pricing of options. They were the ones who discovered how to price options. But guys I like, there's a guy named Vilfredo Pareto who said 80% of your returns in life come from 20% of your action. And he's went on to prove how that works. And so many, I know as a broker, 80% of my revenue as a broker from 20% of my clients. 80% of any kind of results I got was like 20% of my efforts. But the key in budgeting is to find out what is that 20% you've got to really focus on. And I think the big question is going to be revenue. I think revenue is going to become one of the key elements of the forecasts and budgets. The Dow Jones big stocks only had about a 2% revenue going in the last quarter. That's very bad.
Wow. I'll tell you what, hold that thought, and let's kind of pick it up when you come back. And,
I'll just give an overview on what we see here. Okay.
Sure. We'll be right back, folks.
I'm here.
Hey.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got Eric Courtney with us. Eric, are you still there?
I'm still here, John. I was just going to go on about that revenue thing for a second.
Cool. Let's get right into it.
Yeah.
Getting ready to get interesting there.
Well, I think the revenue side of the equation is going to be one of the things that most analysts are looking at a lot harder. We had talked recently about how analysts are looking at stocks that are doing well in terms of the ecological factors that are going to get a markup. But I think revenue is going to become critical. Now, your Alibabas and all those things, those big names are going to look good, and Christmas is going to look good. But I think that revenue is going to be very tough next year across the board. It may not be as tough on the S&P 500 name stocks, but it will be tougher on the bigger stocks. And I think that your first quarter of 2015 is going to look very good versus the first quarter we had this year. If you remember, we were all frozen. We were standing at a bus stop shivering. So the bottom line is first quarter is looking good, and I think the market is looking at that, and that's why you're seeing, such tremendous market performance. But I'm not sure what we're going to see in the second quarter, because there you're going to start seeing two things happen. The energy situation is going to impact on earnings side to the plus side for many companies, but in the big names, it's going to hurt the oil-related industries. And the strong dollar is going to start to come into play. But for now, honestly, it doesn't look so bad. I mean, you don't want to be short. It's okay to be long. Your thesis and the way you do it, and you drill down. I mean, as a money manager, you've given me the ideas, you give me the benchmarks and where they're going, the S&Ps, etc. You know, when I sit down and talk to people about what I did and why I did it, I've got to have a benchmark analysis. I can't just say, oh well, you know, gee, I liked I did very well with the Gilead, and so you should make me, be happy with me. I've got to know the whole ball game, and you have the whole ball game there.
Well, I appreciate it. I mean, it's been easy at times. Some of the things that we talked about have kind of had a ace in our back pocket with some central bank or central government kind of MOs shoving the trade that way, but that's kind of caused some other trades to go certain ways at the same time that really were related to those types of plays. But the technicals, like you said, I mean, they've really driven the whole.
They're the decision making. Yeah, that's where you make your decision. I mean, every trader, has in the back of his head ideas over the economy, etc. A lot of guys don't, but think about it too much. They just look at what they're doing technically. But I think the big money and the big managers and a lot of the big volume comes from people that have a little bit of a sense of what's going on. Look, Keynes, all right? Keynes would be turning over in his grave right now because his biggest fear was a liquidity trap, meaning very simply zero interest rates and nobody wants to borrow. What do you think we're in right now? I mean, exactly. Commerce Bank is charging money to put money in their bank. You're finding all kinds of funny things happening. A big ad in today's Wall Street Journal, Synchrony Bank says we'll pay 1%. Just have a huge full-page ad. Now, I never knew who the hell Synchrony Bank was, so I looked them up. They got a branch in Bridgewater, New Jersey. All right, that's their branch. But they've got a full-page ad. Look, we're going to pay 1% on your, so I can see all the poor people out there. Oh, I can get 1% instead of having to pay 1% at Commerce. It's gotten out of control. But that's where we are. The other thing I wanted to chat with you about is, we were talking. Michael Lewis has given Wall Street, many black eyes in his books. With all the ones, The Great Trade and the Flash Boys and all. But the energy industry, I've started to take a look at some of the numbers. There's nobody that takes more money off the table than the energy industry. I mean, just in Kazakhstan, they had one deal that they had a $30 billion budget for. It came in at $43 billion, and it didn't work. Now, that's $13 billion. Now, I happen to know people in the oil industry equipment supply business, and they change prices. They do what they want. I mean, not everyone is the Christian Brothers out there in the oil industry, and believe me, the money that you see and the way they throw budgets around and dollars around is just phenomenal. And anybody who can sit down and analyze that is going to have a hell of a bestseller, because it does affect us. It's you and I that have to end up paying those prices. So the oil industry is, been, really, they're waiting for somebody like a Michael Lewis to come take a hard look at them. How are you feeling about some of those other indices, the other currencies over there in Asia? The baht and the Singapore dollar and all that. Do you have any thoughts on those?
Yeah, Singapore is a little bit different story. I mean,
Did you hear me?
Folks, yeah, I can hear you. I don't know if most folks know this, but, Singapore's a sum total of about 20 kilometers by 20 kilometers. I mean, it's not a very big place. And it's kind of, if you look at it geographically, go to Google Earth, Singapore's kind of like this separated piece of real estate that, there's a lot of water down that kind of peninsula of that part of Malaysia. And Singapore, has become, Jimmy Rogers moved there, obviously, everybody knows that. And he moved there because, the whole place is just a financial center. And it's, what's the guy for Facebook, the kid that started that? His name escapes me right now. Zuckerberg.
Zuckerberg, yeah, right.
Yeah.
Right.
He kind of, didn't he renounce his U.S. citizenship and took on a Singapore citizenship? There's a lot of things like that there that people just kind of run to. It's a cool place. It's hot as heck. I mean, it's so humid there. I can't stand to go there. But it's very orderly. It's I call it Disneyland with the death penalty is what I call it, because they are intolerant of drugs there on any level. But the whole place is so manicured. There's so much money there that everywhere you go, I mean, guys that are digging holes on the side of the road are wearing collared shirts, and I'm not joking. I mean, it's a kind of an insane place. But the Singapore dollar is relatively stable. Most of these Asian currencies I think are just looking for reasons to pull a Japan, because we've enabled that thinking. I've talked about that a lot, and that is an experiment. What we did, I think I talked yesterday about, the Bank of Japan is actually okay. From what I heard from some guys in Tokyo, maybe this got out on the broad news service, but they're okay with having their balance sheet equal the GDP of Japan. If you can even really get your arms around that or mind around it, I mean that is crazy. That is I don't know where to begin, but I mean that we've enabled that thinking. So a lot of the Asian currencies, to go back to what you said, I mean they're just kind of looking for. I don't see those things getting stronger, to be honest with you. I see that's just kind of the MO of what is to come, and that experiment that we started with the bond market and us taking on over 4 or 5 trillion on the Fed balance sheet and kind of wiping out taking the problems of risque, Bank of America, countrywide type moves, and just taking it onto the government's shoulders, and just kind of throwing it away like it never happened. I don't know how that's going to end, and I've talked about that a lot, but it's just kind of scary in general. And now the whole world's thinking, hey, it worked out for them. But, we don't know ultimately how that's going to work out. And I think I killed my Japanese yen chart here. Hold on. JPY.
Don't kill the yen. Don't kill the Japanese yen chart.
I didn't kill it, but
while you're looking for that chart, I just want to mention one thing I forgot to mention on the revenue side and on the earnings side and on what we're looking at next year on the budgets. I see capital expenditures on the part of corporate America not doing very well. Everybody has this hopeful expectation that capital expenditures are going to explode. They're going to be buying computers, and they're going to be buying not too many PCs. I see all the guys are now mobile. They're not PC anymore. But, everybody's going to be, they're going to create jobs. John, it's not going to happen. I mean, they're not going to look at a great budget situation. They are not going to be spending the money we think they're going to be spending. So CapEx people are, I'm afraid going to be disappointed, as well as better jobs, especially in the political climate we're in. I mean, this political climate is getting out of control. I mean, I don't know what's going on, but I mean, I go back to some of the basics on, Keynes was what they called a saltwater economist. The East Coast and the West Coast were the people who believed in deficit and financing and government spending and surpluses and all of that. But the other part of the country was called the freshwater economists, who would be Milton Friedman. And the fact is, all he really cared about was money supply. That was going to run the way the world would work. So you have the freshwater economists in the Midwest, pretty much, money supply guys, and the East and West Coast were the Keynesian type characters. So it'd be interesting to try to figure what the side of the equation is going to turn out as in terms of the Asia. Asia is a real contagion type country. I remember 98. I mean, one fell, and one shoe dropped, and everything else, and everything. Next thing you know, the world was falling apart in terms of contagion. So I think that's a question mark the market has to keep in mind.
That's fair statement. I'm going to pull up something, Eric. Some guys in the den wanted me to pull up the S&Ps and gold. Hang tight there. We got about 4 minutes left on this segment.
You go ahead, and I'll pull off. I'm going to.
I want you to hang around. Actually, I want to actually ask you a couple more questions.
Okay,
and
hang on.
I'm getting my charts back up here.
See if Edmundo was great the other day on what's going on in Europe.
Yeah, it's nice to, we're kind of like the circle of global friends, I guess, or whatever. I mean, Juan's in South America, Eddie's in Europe, Steve and Peter, Steve's in Chicago, you're in New York, and I'm in Asia. And there's okay, I will get gold, and the S&P's up shortly here, guys. But I got two friends that are coming here from Hong Kong that are going to be here on December 1st. So the Monday show, December 1st, we're going to try to have, one of the guys that's coming he was a customer of ours on Bloomberg, and he runs J.P. Morgan's Asia trading desk, like entirely. He's the desk manager. So he's going to be here. And then another friend of mine who just sold his brokerage firm in Hong Kong is going to be with him. And he lives in Midlands, right above the financial Central Center in Hong Kong. And
he's going to be a great show.
He's a great show. Hopefully we'll have him on for 2 days. But let me pull up gold here really quick. Talked about this a little bit earlier, but let's just kind of rehash the technicals.
I'm going to have to call my pawnbrokers and find out what's going on with gold.
Hey, it's not always not a bad idea. Here's the situation on gold on the daily. Talked about this earlier. 1180. I'm going to just have to say uncle below there, and just kind of see what it does down here in the fair auction. But right now, with the dollar doing what it's doing, and gold kind of stuck its neck closed above these profiles, I think gold's got a really good chance to move up here. And at some point, the dollar may turn south, and that may give gold all the reasons to really launch another 100 points north. So I'm kind of becoming a little longish on gold again. I was thinking this was going to happen above the 1227 area, but then we started having some breakdowns below 1241 when we were up there, and I was like, tried it again around 1218, and then hands off after that. But that's the cool thing about the profiles, which regulate, in my opinion, the entries. It just gives you really good technical reasons, I think, to kind of sit on your hands, or just get back in the game when it's okay to be long or okay to be short. So that's my take on gold.
If you spend 20% of your effort looking at the scanner and drilling down and doing all of the center of gravity work that you've been able to explain, you're going to get an 80% return. Your life will be a lot better. You won't have to get up at 4 o'clock in the morning and listen to some guy out of China telling you what's happening and, all of that.
You said something earlier that really almost made me bust out laughing, because it made me remember something I heard in Anchorman. And when you were talking about 80% is I forgot what you said actually, but I'd love for you to say it again.
20% of your effort gives you 80% of your return. That's right. Yeah.
Right. I remember in Anchorman, if anybody saw that movie, the guy was saying 60% of the time it works every time. And I was like, what? That didn't make sense. But that was a funny line in Anchorman. Well, look, we're going to go to our next break. Eric, appreciate you coming on today. I'm going to run through some things before the close here. But thanks for coming on. It was enjoyable as usual.
Thank you very much, John. Have a great day. Talk to you.
Okay.
Bye-bye.
Thanks, man. Bye.
Bye.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. When you first learn something in life, you have the most questions as you begin to apply that knowledge, which is why Steve Rhodes came up with the idea for his 7-week trading program. It all begins Saturday, November 22nd, when Steve Rhodes will host a live 3-hour morning workshop where he'll teach his attendees the precise methodology he uses when placing trades. You'll then receive 6 weekly updates each Monday morning discussing the possible alerts currently setting up in the market. Steve will then bring everyone back together for a final 3-hour live workshop Friday, January 9th, where he'll discuss the methodology that went into each of the 6 weekly updates, making sure that you're confident in applying what you've learned so that you can begin navigating the market on your own. You can sign up right now for this entire 7-week trading program with Steve Rhodes for a one-time payment of only $395. If you're a Mastering Probability subscriber, then you can save an extra $100 off that price. For all the details, visit the front page of TFNN.com right now.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Hi, guys. Welcome back to the show, and thank you, Eric Courtney. It is always a pleasure to have you on and to hear some of those fundamental thoughts and what the real deal is. I've got the S&Ps up right now. Somebody in the den wanted to kind of explore this a little bit more. Here's that 214 weekly unfair high. This is our weekly, and if we can show that. Okay. Well, you're in luck. Steve Rhodes is actually going to be on time, and he's going to do the next show, and I don't have to fill in for him, and that's probably to your benefit. So just got that word from Steve. So the weekly 214.50 here. That's the unfair high. That's the kind of, and you know, just kind of going back in time the past 2 weeks, we had that close above. We came back and retested very close to that 214.50. Let me just kind of blow this up a little bit so you can see it. Well, didn't actually get there. But what that was actually was getting to that DMZ we talked about. There's a 214.50. This is the weekly. And here's that other inflection point we were paying attention to severely back then 2 weeks ago, which was 219.25. So we had that close above the weekly and daily and then come back and retest. What did we reach there? 220, 221, 20. I'm sorry, 2019, 2020. The unfair highs on the daily box were 2019. So we use that 2019, 2014 DMZ as kind of a huge area to pay attention to. And now we've got on our daily 214 219 previous unfair low, and that lines up with the weekly unfair high. So maximum support on this, which actually has to hold, is going to be around that DMZ we just talked about. And, we've talked this morning about, hey, if it ain't broke, don't fix it. The breadth is positive on the intermediate and long term. We're going to have some noise around here. But if we get a little bit too far below this inflection point at 2038, I'm personally going to have to sit on the sidelines for a while and wait until we either come down into this 214, 219 area to kind of strap myself in again, or get back above 2038. So again, it's telling you 2038 and or 2014, 2019. Now you could look at this depending on your style of trading, if you will, as this may be an accumulation all the way down for longs. I actually don't like to trade like that because I don't personally like to just kind of double up too much. But if that's something that you feel comfortable with and has worked for you in the past, or has been in some trading plan that you've been taught, and you've got stops in, by all means, go for it. It's just not my style. So that's the take on the S&Ps and gold as we were kind of heading towards the end here. What else I want to talk about as we close here? We've got about 45 seconds left. We talked about this yen Nikkei disconnect, and I've been, I'm in Asia. I'm very aware of what's going on over this way, and I get calls constantly during the day. I think this spread's going to widen, and I think the Nikkei, we talked about that disconnect before it happened, actually, and we talked about, one side of the equal sign, the other side of the equal sign, and monetarily balancing that spread out, so to speak. It's been a decent situation, and I think it's actually going to get better. And if you remember, we kind of paired it against S&P's equals Dow plus NASDAQ, kind of keeping that thing balanced. That was a little bit easier equation to kind of balance out because you have three components. But I'm still a big fan of this trade, and that's been the home run situation since 101.33 the yen has. So, guys, you've been great. Thanks for listening today. Eric, thank you for coming on. Steve Rhodes is next. He made it back, so you'll get to enjoy him now. Have a good day trading, guys.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.